the Federal Reserve cut 50 basis points at their meeting yesterday. So the Fed is run by Jay Powell. Everybody's seen the meme of him with the money gun. Basically, yesterday they officially cut 50. They're going to project another 50 basis points in cuts for the rest of this year and another 100 for next year. So the Federal Reserve is the U.S. central bank. They're the ones that are supposed to make sure that nothing happens to the banking system and that they're like the lender of last resort, and they kind of help just in case there's some sort of a financial crisis. They're the ones that are supposed to step in those instances. But most importantly, their main function is that through monetary policy, which is setting the interest rate, the federal funds rate, they're supposed to either try and slow down inflation or help spur economic growth. So their goal with the monetary policy, they use interest rates to influence the economy. The banks, now this is why that's important. The banks use the federal funds rate as a benchmark for what type of loan rates and borrowing costs that people are going to get for taking out credit. So over the last couple of years, since 2022, the Fed took the rates from 0 up to between 5 and 5.5%. So because of this, it makes it so that credit is harder to get. And if, just look at housing mortgages, for an example. 2 years ago, you get a house for 3 to 4%. Now you're looking more like 7 to 8%. And that's for like a well-qualified buyer. So by the Fed starting to lower interest rates, what they're basically letting the economy know and America know is that they're going to continue to lower it more. So their goals are also to make sure that prices remain stable. That's why when inflation was going crazy, they raised the interest rates to try and bring those prices under control from running away too high. Also, let's see what else they got. So they're also supposed to, this is very important, in addition to price stability, is they're supposed to maintain maximum employment in the economy. So their goal is to make sure that a lot of people don't get unemployed, because the basic idea of interest rates is that when money is easier to access, people are going to grow their businesses because it's cheaper to borrow money. And if you grow your business, one of the things that you do when you grow your business is you hire more employees. So that's the idea. So the Fed is doing this for multiple different reasons. I think that the main reason that they waited till right now, this is the last Federal Reserve meeting before the election. So you got to remember, even though the Fed is an independent organization, they're appointed by the government. Like Jay Powell had to go through a selection process and be nominated by the government and be selected. So they're supposed to be independent of whatever the government is doing, though they work hand in hand with the government. So him doing a 50 basis point cut before the election, it should help goose the stock market a little bit because, if he gets, depending on who gets elected, the economy is going to have a big part to do with it. So he has a large role to play in that. So he kind of let us know that this is what was coming. So everybody knew that the rates were going to be cut. The question was, is it going to be 25 basis points or 50 basis points, which is either 0.25% or 0.5%, right? So just think about that interest rate that we were talking about. Basis point is just a fancy way of saying 1 percentage point. So when they say 50 basis points, they mean 50 percentage points. So think about 1%, 50 basis points is 50% of that. So he let everybody know in Jackson Hole. At Jackson Hole, he let everybody know that the monetary policy stance that they had was going to shift from being restrictive and hawkish. Those are the two terms you're going to hear a lot. Restrictive and hawkish means that they're keeping rates high and they're trying to keep inflation down because inflation is going up. And the idea behind that is simple. I'm going to explain that in a moment. And then when they're dovish or accommodative, which is now the monetary stance that they've entered into, means that they're going to encourage economic activity. So the way that interest rates accomplish this is simple. So just imagine that the government bond rate is like 5%, which is what it's been for the last couple of years, right? For a short-term government bond. If you can just get 5% risk-free, the reason that they say that it's risk-free is because the safest asset in the world as of now, and the way people view it, the most liquid market in the world, is U.S. Treasury bonds, right? Because they're backed by the U.S. government. Right now, the U.S. government is still way more stable economically than anybody else, and that's looked to as the risk-free rate. So you put the money in there, even though the price of the bond may change, it's very unlikely that the government is going to go out of business. If the government goes out of business, we're in all kinds of other trouble. So what happens is when you take a 2-year bond, 5-year, 10-year bond, the idea is you give the government this money for this set period of time. During this period of time, they pay you an interest rate because they borrowed this money from you. So when they borrow this money from you, you can sell the bond before its maturity. And when I say its maturity, that's when the bond's time period is up, right? So if it's a 10-year bond that you're getting 5% for, basically you're saying, here's $100 U.S. government. You're going to pay me $5 a year for the next 10 years. And then at the end of the 10 years, I get my $100 back. The reason that that's considered risk-free is because when you look at other investments, like a stock, for example, even Apple is the best company in the world as far as making money and one of the best brands. Technically speaking, Apple could go out of business, right? Something can happen where, they do something illegal or whatever it is, right? Even though it's very, very unlikely, just like it's very unlikely that the government is going to go out of business anytime soon. It's possible, but it's unlikely, right? It's a low probability. So, like, if you get a corporate bond from somebody like Apple, it's going to be close to treasury rates that you get from the U.S. government because Apple is considered such a good business. Now, if you go to an up-and-coming company that doesn't make a lot of money, they're going to be giving you a lot more interest because you're taking on more risk, right? So, like, let's say it's an up-and-coming biotech company. They're working on a cure for some sort of disease. You don't know if it's going to work. So there's always a chance that it doesn't work, but they need money, so they raise rates. I mean, they raise money by selling bonds. Those bonds might get 10%, 15%, which sounds crazy. But in reality, there's a higher chance that at the end of the 10 years, you're not going to get your money back. But that's why they give you a higher interest rate to do so. So the risk-free rate everybody goes off of is U.S. Treasuries. Those are the ones that the government sells in different time increments to fund different government spending, which we know they do a lot of. And that's considered risk-free because you don't think the government's going to fail. So if you're getting 5% to just sit there and do nothing and have no risk, people are going to save more money. So I said all of that. Basically, here's the main point. When you have money and you're able to get money for saving that money and not spending it, that should slow down economic activity, right? Economics 101. Every dollar that you spend is a dollar that someone else receives, and then that's another dollar they could spend, and on goes the cycle as money flows through the economy. So when people are saving more because interest rates are high and you're getting a certain amount of money to just sit around and not do anything, economic activity should slow down. So that's how the interest rate kind of sets how much activity is going on, right? So now if the interest rates are high, people can't get approved for as much money, housing prices, all those things are going to be affected by what interest rate people can get for the money that they want to borrow. So if the interest rates start to come down, money becomes easier to get. Money starts flowing more through the economy. That's the idea behind where they're going and what they're now calling their accommodative stance and being dovish. The two animals they use is dove and hawk. Hawk means restrictive, like I said before, when they're, raising rates or keeping rates high. Dovish or accommodative is when they're starting to lower rates and try to kind of give more liquidity to the system. So that's the shift that we've gone through. Now, they did 50 basis points. Now, there's no guarantee that they're going to do more rate cuts before the end of the year. They come out with what's called a summary of economic projections. Basically, that's just a chart of what all the members of the Federal Reserve kind of think about as or look at here, this is what we think we're going to do. Data can always come in and change those ideas that they have, and the projections can change at any moment. But as of right now, the chairman of the Federal Reserve, Jerome Powell, is basically letting us know that rates are coming down, right? He already started with half a basis point, 50 percentage points, and he says that they're going to continue to do so. So think about how that's going to affect you. Like I said, it's supposed to spur more economic activity. Right now, the unemployment rate's still in the 4% range. They're looking at it like, okay, potentially more economic downturns may be coming. So in order to front run that, that's one reason that they might be lowering interest rates. Another reason that they might be doing it is what I mentioned earlier, that they might just be trying to get that last little goose of the stock markets and different things so that, it looks good for the presidential incumbent, or in this case, the vice presidential incumbent that's running for president. So because they're the person that's going to decide whether they want to nominate him again. I believe his term is up next year or the year after. So if he wants to keep his job, they might be pressuring him behind the scenes. So people are looking at this. It could be a politically motivated decision. And now we're going to find out if inflation is really under control. So the reason that they've been this restrictive for the last couple of years is because everyone knows, you all felt it. Prices were going crazy. Inflation was going crazy. So they did what they had to do to bring inflation down. And remember, I personally think that supply shocks did have something to do with the inflation from COVID, right? Because remember, everybody in COVID, it was hard to get things. You couldn't get people to work, and different supply chains got messed up. And there's a combination of people taking advantage and just raising prices because they could. But I also think that they doubled the money supply. If there's double the money available, that money has to find places to go. That's why the stock market has run up crazy over the last couple of years. So there's still all that underlying money or liquidity. So now that rates start to come down, if people start to put that money to work, we're going to see if inflation comes back. And if inflation comes back, then they're going to have to tamp down how accommodative they want to be. And that's something that they gave themselves with the way that the Fed is set up. They do this meeting every 45 to 60 days. And they decide, all right, based on the data that we have, do we continue down this path that we kind of set in motion, or do we start to change? They have optionality. Right after the election, they might go right back to, we just don't feel it's appropriate to continue to do so. I think that in the short term, it's gonna basically cause a little bit of a push into the stock market. I think small cap companies, I mentioned this on a previous podcast, I think small cap companies are going to start to catch up to the mega caps, because the reason that people want to stay away from smaller companies when interest rates are high, it goes back to what I brought up about how companies raise money. They either do it through profits or they do it through offering bonds. So if a company is a little bit more unsafe as far as their future goes, it's going to be harder for them to raise money because they're going to have to pay much higher rates, which is going to be difficult for them to do. Whereas if rates are low, they can get lower rates for their bonds. They don't have to pay out as much interest. It's going to help fuel more growth in those lower companies. Companies like Apple, Google, Microsoft is not going to affect them. There's the most fiscally responsible companies in the world. They just print money, basically. So they're not going to be as affected by this. But smaller companies will. And that's why I like what Tom Lee, he's a contributor for CNBC, and he talks about a lot of different things. Ever since COVID, he became real popular because he was very, very positive early on. So he thinks that small caps also will break out. And the reason that he gave for this was that historically, when you get like a market top, meaning that we hit the highs of this particular cycle, small caps will confirm that. And right now, with the price to earnings ratio that small caps are trading at, which he mentioned were 10, this would be the lowest that they've ever traded at relative to close to being at a market top. So before we can kind of hit whatever that high is going to be during this cycle, he thinks that small caps need to confirm it. I actually agree. I already felt like small caps were going to start to break out. That was part of the reason behind the trade that I have. I'll give more of an update on that that I'm gonna be in that trade for probably another week, another month. But I'll go into that trade update in a moment. But yeah, so the other idea behind bonds versus using your money. So now, like I said, if you were getting 5 to 6% or whatever it is that you're getting to just sit around, now you have to look for more risk. And again, that also feeds into that small cap narrative that people are going to look for more growth stocks because they're going to be looking to try and make up that yield that they're not going to get as easily from bonds, which are supposed to be risk-free. Now, as far as the update on my trade, I currently am down on it. The two companies that I'm in are Sports Radar and Genius Sports. I think that, sports betting is huge. We're in the midst of the NFL season. The NBA season is getting ready to kick off. They're both at points on the chart that can show like a potential breakout about to happen. Hopefully it happens during the time period that I'm in the trade. I like to share my trade as for informational and entertainment purposes. So I think that they still have a chance with the decision that the Fed made. I think that's going to give them that gasoline to kind of break out. That's the fuel that they need. The other market outlook that I kind of want to go into the weeds a little bit of what I think is going to happen over the next couple of years. So I think that we are going to be heading for a very, very large drop in the stock market just because when it goes up like this, at some point, it does have to come down. The tricky part is trying to time it, right? I got no clue when that can happen. It can happen probably next year or the year after. I do think it does come in the next couple of years, and I'll start to position for that accordingly. I think we probably run up into the end of the year, especially into the election. If I see a drop in like the big stocks, I might look for a chance to get into those to try and catch a run into the end of the year. But I do think eventually we are going to see a really, really big drop, and the Fed's not going to have as many tools to try and get us out of it just because of all the money that's been printed. Inflation potentially coming back is a real thing. If you want to look at the history of inflation, just look up, when Arthur Burns was the Federal Reserve chairman and how they, had to raise interest rates like, I think it was like 10, 15%. They came down and then it came back up. That's what a lot of people are pointing to that's going to potentially happen here. We don't know yet. We're in a very different time. Like I said, we've never gone through the type of situations we've gone through over the last few years. So it's going to be hard to have history draw a parallel to what's happening now. But one thing is for certain, human psychology tends to work in cycles. Eventually, you're going to get everybody FOMOing in at one point, and then at some point, everybody's going to get fearful. We just don't know when that cycle is going to happen. This is what Warren Buffett has famously taken advantage of over his decades of investing, and this is why he just continuously raises cash and looks for good opportunities to enter the market when he feels like his quote, blood on the street. So that's what I think is going to happen as far as the stock market, and I think it's a big deal. I'm going to just wrap up my thoughts on what the Federal Reserve did here. I think it's a big deal that they are starting this accommodative part of the cycle here. And we don't know how this is going to go because inflation could come back. Those are the main things that we got to look for. How low can they get interest rates? How fast can they get them there? What type of economic downturn do we get as a result of what they possibly see? They're trying to front run any sort of economic downturn. Let's see if they're successful in doing so. And let's see how low they could get rates. And let's see if inflation comes back. Those are going to be the main things I'm looking for.